Peter, good to see you.
Good to see you.
Thank you so much for joining us.
Absolutely.
Yeah, love to see you and get a check on what's going on in these markets and for deals, because I know earlier in the year, well, obviously we started the year off, it was the worst beginning of the year, of any year for markets, and the deal flow really slowed down. How would you characterize deals and the M&A opportunities today?
Yeah, so there's no question that the volatility we saw right off the bat in January slowed down deal activity. Deal activity, you need confidence. CEOs need to be confident, boards need to be confident in order to keep that momentum that we saw in 2015 in M&A activity. The volatility definitely had everyone take a pause. I'd say the companies still are very active in terms of talking about targets, thinking about things they want to do strategically. And now that markets have settled, we're starting in the last few weeks to see deal activity picking up a little bit again.
So what sectors do you think are poised to see the best consolidation?
Well, you're going to continue to see activity in healthcare, and you saw that start up again last week. I think there's a lot going on in tech, around media and content. There's a lot of disruption there. I think you're starting also to see some industrial consolidation on a global basis. And the fact that industrial businesses have been a little bit more pressured for growth, I think is really having an impact on CEOs in that space.
What is it going to take, do you think, to move the needle on economic growth? I mean, you know, you're talking about an economy that's sort of bumping along the bottom. We certainly are seeing better numbers when it comes to jobs. But for the most part, you're not really seeing a vibrant story for the U.S. economy. What do you think changes that?
You know, look, I think the U.S. economy is doing fine. I think that it's a complicated picture, but there's no question some of the things we've just been talking about, heavy regulatory hand, political volatility, all of that contributes to high taxes, all that contributes to confidence with respect to investment. And I think we've got to get to a point in time when investment is more encouraged, there's more support from the regulatory framework for some of the things we've been talking about, and that's going to take some time.
Perhaps an election. The election creates a catalyst for that.
Well, the election could, but you know, we'll see. Elections always create uncertainty. So by the way, another thing that's a headwind to some of the things we're talking about is the fact that until you go through the process of that election and know what you have on the other side, it's hard to understand how that's going to affect markets.
Money is mobile.
Absolutely. Money is mobile. We live in a global world,
right,
and it's very easy to move money around the world. You know, we definitely are in need of corporate tax reform. Corporate tax reform certainly could spur more investment in the U.S., and all of this is complicated, and the political landscape, I think, further complicates it.
Let me get your take on valuations, private and public markets. First on the private. For a little while there, the valuations were coming down because people just thought, look, these companies can't possibly be worth, like an Uber being worth $60 billion. What's your take on valuations in the private sector and what that's telling us about investing today in markets today?
Yeah, so there's no question over the last 6 months, private market valuations have cooled, and I think that's been healthy. I think investors were very willing to give private companies capital to fund growth without really holding those companies accountable for delivering on metrics other than just top-line growth. When can you translate that top-line growth into some sort of return? And I think now venture capitalists and private investors are getting more disciplined about that, and I think that's generally healthy. Are the valuations still robust? Sure. But certainly they've come in, and it's getting a lot harder to raise that private capital. So venture capitalists now are saying to companies, hey, I want a plan that assumes that you can't raise more capital and assumes that with the capital you have, you can get to a point that we're going to start to see some return in the business. And I think that's something that will continue through this year.
So there were valuation questions, but then there were also questions about the overall demand story. China, Europe, emerging markets. What's your take on what's going on in the backdrop for all of this?
So look, as you kind of move around the world, there's no question that while we were just talking about sluggish growth in the U.S. at the moment seems to be the most attractive economy in terms of what's happening. China's growing. There's going to be volatility in that growth. And, you know, to put it in a broader context, I'd bet a lot that over the next 25 years, China grows quite a bit. During that growth, there can be a lot of volatility along the way. Things can go wrong. But from here to there, you know, I think China's going to continue to grow and be really important to global growth overall. But I think investors are starting to recognize that in some of these newer emerging economies, there are risks. And in the more developed economies, even though the growth might be a little bit slower, there's certainly a greater sense of stability, through that cycle.
Is there a candidate out there that you think will be better for business and markets than another candidate?
Look, there's a lot of uncertainty for markets around this election, but we'll see what the election delivers, and then we'll all adjust and adapt, to that result accordingly.
David, great to have you on the program today.
Absolutely. Thank you. Always nice to see you, Maria.
And
Thank you very much.
David Solomon is the co-head of investment banking at Goldman Sachs.